Goldman Sachs chief economist Jan Hatzius joins us here at Post 9 to break down what it all means for stocks and, of course, the Fed. Jan, always great to see you. Does this materially change your view of what the Fed does next week or week plus?
No, I think at the margin, it probably confirms that a cut is likely in December. That's not because of the payroll numbers. Those were obviously quite strong, but really more the household survey, which showed an increase in the unemployment rate and also a decline in household employment. So I think that supports the idea that the labor market's still in the rebalancing process. And yeah, I think it probably means a cut. Still not certain. We obviously have inflation numbers next week, but I do expect it.
And speaking of inflation, what we've been hearing in these retail conference calls is the talk about tariffs, of course, and the impact on price. And pretty much they say that it's going to be paid by somebody else. The consumer will probably pick up the tab. Mattel said that on their conference call. They're going to pass that price increase along to the consumer, so you might pay more for a Barbie doll or whatnot. How do you sort of forecast into your view of inflation and whether or not the Fed can actually reach 2%? Because it seems like the consensus on Wall Street is that 2% is not going to be hit. It's going to be more like 3%.
Well, 2% in 2025, if we do get a meaningful tariff increase, I think is probably too optimistic. And we had a forecast of about 2% before we built tariffs into the forecast. But now we're at 2.4% for core PCE inflation by the end of next year. So there's still a lot of uncertainty. We don't know what kind of tariffs are really going to come. Is it going to be just the China and maybe auto tariffs, which is our baseline? Or is there also going to be a broader across-the-board tariff? That would add to that 2.4% if it's a bigger tariff. The other thing to keep in mind, though, is that this is more of a one-time level increase in prices. And you should think of it a little bit like a value-added tax hike, which we've often seen in Europe. So you get a higher inflation number, but then as you look forward, that drops out of the numbers eventually. I think the underlying trend is still disinflation, and today's jobs numbers underscore that. You have a labor market that's still cooling off, and I think that's going to keep inflation pressure coming down.
Although there are some questions this morning about 3-month annualized wages up 4.4. How does that fit with 2% inflation, right?
That's higher than expected. So that number was a hotter aspect of the jobs report. You're right. I would say if you take the production and non-supervisory workers, which often is a somewhat like more stable measure of wages, that was a little bit cooler. But you're right. If we keep growing at 4% plus, that's probably a little too high to get down to 2% on price inflation.
Is oil a big, you think, disinflationary force? Is it worth watching?
It hasn't moved that much. So far, I think if you just look over the last several months, I think it's consistent still with disinflation, which is our baseline. I don't think it's as much of a fresh impulse, because for that you probably would need some bigger moves. And those could happen. I'd say in the near term, the risk is probably a bit more to the upside because of potential tensions with Iran. Longer term, we think, this kind of $70 to $85 range for Brent that we're forecasting, risks to that might be a little bit more to the downside if there is more investment and more production.
I know stocks aren't your thing, Jan, but we've got markets at record highs effectively. So we have this wealth effect going. We've got the impact of tariffs, potentially upward pressure on wages. I'm just wondering if you think that the Fed's path, in your view, is certainly in the cutting, or if there's a possibility down the road of a hike.
So I wouldn't say stocks aren't my thing, but
okay. I mean, in terms of a forecast or whatnot.
I do think that the environment that we're forecasting for 2025 is generally a market-friendly, including stock market-friendly environment. Okay. We have the economy growing at 2.5%, and we have inflation still edging lower, despite the tariff point that we discussed. We have the Fed still delivering gradual cuts. All of that should be pretty supportive. And our strategy team, led by David Costin, has a 6,500 price target for the S&P 500 in a year's time. So that's a pretty it's a pretty constructive environment. Obviously, the market has moved a long way. It's valuations are definitely high. That's a counter argument. But the macro environment that we're predicting is pretty supportive.